In this lesson, we're going to cover the basics of options pricing. So here's what we're going to cover. In this lesson and the following, we'll discuss the key factors related to options pricing, volatility, what it is and its influence on options pricing, the difference between intrinsic and extrinsic value, a deeper dive into the effects and importance of understanding volatility when trading options. So why should you care about pricing? To make smarter choices by understanding how different factors influence option prices, you can position yourself to maximize profits and reduce risk. It's like knowing when a deal is actually worth it or not. But before we get into the nitty-gritty of option pricing, let's think about pricing options as how insurance companies price policies. A quick metaphor to describe option pricing, so how insurance companies price policies. Imagine you're shopping for car insurance. Just like how an insurance company assesses various factors to price your policy, options pricing also involves assessing various factors to determine the option's value. So here's the analogy continued. Risk management, so car insurance policy. An insurance company looks at factors like your driving history, so how crazy and volatile of a driver you are, the type of car you have, where you live, and how often you drive. And this is akin to assessing risk associated with insuring you. With options pricing, factors like the underlying asset's volatility, the time until the option expires, the current price of the asset compared to the strike price, akin to your car's value versus risk factors, and prevailing market conditions are considered. This is similar to how insurance companies assess risk of insuring a car. Now, the coverage period. Your policy has a specific duration. You're covered as long as you pay the premium and the policy is in effect. Options have expiration dates, just like an insurance policy has a coverage period. The value of the option is tied into this time frame, with longer duration usually leading to higher premiums, much like longer insurance policy terms might cost more. The premium. With the car insurance, the insurance company sets a premium, the price you pay for the insurance. Higher risk factors, like a history of accidents or a high performance car, lead to higher premiums. With options pricing and premiums, it's just like the insurance. The price or premium of an option reflects the assessed risk. A more volatile stock, for instance, will have a higher options premium, just like a high performance car would have a higher insurance premium. In this metaphor, buying an option is like buying an insurance policy for your car. You pay a premium for the right, but not the obligation, to buy or sell the underlying asset at a predetermined price, just like you pay an insurance premium to cover potential future damages or losses. In both cases, you're managing risk. In options, the risk is of market fluctuations. In insurance, the risk is a car damage or accidents. Next, let's get into the nitty-gritty of options pricing. How are options priced? Complex mathematical formulas like the Black-Scholes and Nomio models are used to set option prices. While many traders lack a deep knowledge of these complex models, in reality, you don't necessarily need to know it yourself. However, it is essential to grasp that an options price hinges on several crucial elements. The option pricing components. You've got the strike price, interest rates, dividends, implied volatility, the expiration date of the option, and the stock price. All of those components are the variables going in for the option pricing model formula. With all those combined, you end up with the option price or the premium for that option. Option pricing components. Underlying asset price. Now, this is the current price of the stock or asset that the option gives you the right to buy or sell. The asset price is mainly used to determine which strike prices are to be used, the in the money, at the money, or out of the money options, and those are each used for certain strategies. The strike price. Option strike prices are important. Depending on where they are in relation to the underlying price will play a key role in determining their specific option pricing. Expiration date. The date on which the option expires. After this date, the option can no longer be exercised and becomes worthless. Time until expiration. The longer the time until the option expires, the more valuable it is. This is because there's more time for the underlying asset price to move in a favorable direction. Options with longer expiration dates, therefore, are priced higher. Interest rates. The prevailing interest rates can also affect options pricing, though their impact is usually less direct. Higher interest rates can increase the cost of call options and decrease the cost of put options. Dividends. For stocks that pay dividends, the expected dividends can affect option prices. If a stock is expected to pay dividends during the life of an option, this can decrease the price of call options and increase the price of put options. So the big influence is volatility. Volatility refers to how much the price of the underlying asset is expected to fluctuate over time. Higher volatility increases the chances of the option becoming profitable, so options on more volatile assets are more expensive. Implied volatility, IV. This is a metric used to estimate the future fluctuations in a security's price based on the price of its options. It's called implied because it's derived from the market price of an option. Implied volatility is a measure of uncertainty. High uncertainty often leads to a greater expected range of price movements for an underlying stock. To recap, all of the price components on the left get factored into a pricing model to determine the option's price or premium. While many traders lack a deep knowledge of these complex pricing models, in reality, you don't necessarily need to know them so long as you understand at a higher level the components that go into pricing. Now that you know the different option pricing components, let's turn to the concept of extrinsic and intrinsic value in the next lesson. See you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieved my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.